Hi, this is Patrick Adams with this week's Market in a Minute. We have some interesting things to go over with you. Here are the issues in the market currently, and we added one down here, the war in Ukraine. We see that Russia is going to make a do or die surge as we see it, see if they can overtake the Ukrainian troops. If this would occur, this would be a very big negative for the overall markets. What the markets have been concerned about is a couple things. Obviously, inflation and the restrictive Fed, and I think they're starting to listen to what the Fed's message is. But the earnings have been declining. 2023 earnings started, when they started to forecast them, started at $251. We're now down to $224. And 2022 earnings look like they're going to be about $220. So it looks like the 2023 earnings will probably be somewhere in the 210 or maybe as low as 200 range. It's really hard for stocks to advance while earnings are declining and the Fed's being restrictive. And then you got this another issue emerging with the war in the Ukraine. So the market is advancing while the market is fighting the Fed and the economy as well. Here's a big change. This is a huge change from last week. We talked about this. We talked about the market needing to adjust. This is the federal funds rate. So the federal funds rate expectations ratchets up quite a bit to about 5.25 from 490 where it peaks out, and then it comes down slower to a higher level. So now at 4.7%. Last week the expectation was at 4.2, and the stock market declined about 2% when this occurred. And the bond market also, the 10-year treasury yields went up on that as well. So you can see where it was roughly 3.4% based on the jobs data, which was very strong, and the message from the Federal Reserve. The 10-year treasury went up to 375. As we've discussed quite a bit, a rising 10-year treasury is really bad for the valuations of the stock market. So we think we're okay until we get up above, say, 4%, and then the multiples of the market will have to come down. 18 times is a little high versus where the current yield of the 10-year treasury is. So this is a risk that's coming back into play again, it looks like. Now, Russia announced that they were going to cut oil production by 5% or 500,000 barrels per day. We think it's more that they can't produce that amount of energy anymore, of oil anymore, rather than voluntarily cutting back. But you can see, this is kind of interesting. You can see roughly $80 here. If the market can get back above that level, the oil market price of oil per barrel above $80, we think it's got a shot to 90. And 90 is basically where the 200-day moving average is. So oil prices have fallen from $120 a barrel all the way down to 70, and now started to rally again. And I think what Russia is doing and China reopening, that the pressure on oil prices will be in an upward manner, and it could cause inflation to rekindle back to higher levels again. Now, the technicals of the market have been very strong, and you can see here this is a abbreviated chart of the S&P 500 in blue. You can see it's tried to break above the 200-day moving average several times, and it did a little bit back here in December, and it clearly did it this year, breaking through nicely. And what's really interesting is that the shorter two moving averages, the 20-day right here, it broke through the 200, and also the 50-day broke through the 200-day moving average. So that's the golden cross, as they call it. There's a couple important points in here in the market. The resistance level is about 4120 on the S&P, and good support is around 4,000 and 3940. So these are important levels to watch. Again, if the market breaks back down and goes through the 200-day, it's probably going to go to retesting the lows again. But the market is in an uptrend. It's fighting what the Fed's saying, and it's now starting to fight the bond market a little bit. The bond market's coming around to what the Fed is saying. We've got a really interesting stock that we've waited so long to buy. You can see this is Baxter International. This is a high quality medical products company. It's been in its history well over $90 per share. It's generally traded at 20 times plus earnings. You can see this major decline in the stock. These are just a combination of a bunch of little toe stubbings. Maybe they stubbed their toes on both feet, right? So it's something that hurts, but you didn't break your foot or anything like that. And the pain will go away, but once you do it, it hurts really bad. The stock has basically almost come off the chart here. It has experienced a capitulation sell-off, much like Tesla did at the end of last year. A capitulated sell-off. It not going to have the same springboard as Tesla, but over a 12-month period, we see 50% upside, so back to $60 a share, and then say over a 2 to 2.5 year period, probably back to $80 a share. Now we're looking at currently a trough PE multiple, so in the low teens currently, and earnings that have been really brought down in a big way. So we think that earnings could go back to $4 a share and a 20 multiple over time, which gets you to $80. So again, this stock is a low risk company, blue chip. It's a great company, and it is very undervalued. So we bought it in a number of our strategies last week. So we bought it below $40 a share. If you like our videos, please hit subscribe. You can also sign up for our Market in a Minute email on my website, Patrick Adams CFA. You can sign up for that. We will send you the hard copy of our Market in a Minute. Thanks a lot. I appreciate your attention.